Welcome to part 2 of the latest podcast from the Gold Chronicles with Jim Rickards, presented by Physical Gold Fund. Well, thanks, Jim. And now over to you, Alex. What questions do you have today from our listeners?
Thanks a lot, John. We've got a ton of questions that have come in, so we thank everybody for sending their questions in. There's a lot of really good questions here, so it's kind of hard to choose from them with the time that we have allotted, but we're going to do our best to get some of these answered. Just a brief comment is that in my time in the physical gold industry, which has been almost a decade now, as you well know, Jim, the whole idea of using gold to back the currency or to talk about gold in any legitimate fashion as money has been pretty much laughed at and ridiculed by leading economists and central bankers, etc. And not only is this happening now, this sort of sea change that's currently occurring and is still underway, that's being discussed at some of the highest circles now, but it's also kind of starting to filter down into other people's consciousness. And I'm talking about people who don't make monetary policy, but just the typical person who's concerned about their savings and concerned about protecting their wealth. And a couple of examples, as you know, Jim, you met with the governor of Texas and you were talking to them about this gold vault that they're going to be building soon. There's a new bill that's been passed by Tennessee, or not passed, but introduced in Tennessee to build a similar gold vault in Tennessee. It's also been mentioned in the recent presidential race by several of the candidates. So it's kind of leading to where people are starting to, I think, maybe wake up a little bit, people who didn't necessarily think about these kind of things in the past, which kind of leads me to our first question here. This one's coming from Michael W. So I'm just going to read some of his introduction. He says, Jim, I enjoy your blogs, interviews, and books. He likes the simplicity of your explanations. After reading Currency Wars, my first reaction was what at the time seemed obvious, and that is just simply eliminate competitive devaluation by requiring internationally the pricing of all goods and services everywhere quoted in one currency, ounces or grams of gold. In other words, eliminate country names such as marks, yens, pounds, dollars, etc., and make it some kind of internationally mandatory system. So what he wants to know is, what is your view of that? And is that something that's realistic? I'm paraphrasing a little bit, but that's essentially what he's asking here.
Well, I think it is possible to denominate every good or service in the world in units of gold. I don't think that would be that difficult, but then it begs the question, well, what are we going to do? Are we going to walk around with bags of gold in our pockets? How are you going to get paid on payday? How are you going to pay your rent or your mortgage or buy a new car, etc.? The reason for paper money, which are really just banknotes or just promises, was partly convenience, and the reason for digital money is partly convenience. We always say that the Federal Reserve is printing money, conjures up a printing press with ink and paper, and that is the way they used to do it. And there is still paper money in circulation, but not much in relation to the money. Your money is digital. If you think about it, you may have a few bucks in your wallet. I stopped at the ATM on my way over to do this podcast, so I got a couple 20s in my wallet. But basically, you get paid digitally. You pay your bills online. Use your debit card. Use your credit card. You check your bank account online, etc. It's all digital, which that leads to other issues such as your digital wealth being wiped out by hackers, but let's leave that aside. That even if you denominate everything in gold, you'd still have some kind of token, whether it's a digital token or paper money, to pay for things. And at that point, it begs the question, well, okay, what's the relationship between my token and the gold? Do I still have a dollar bill? Does it take me 5,000 of those dollar bills to get 1 ounce of gold? Or you could have a banking system, I guess, where you combine a digital system and a gold numeraire, where I look at my bank account, instead of so many dollars, I've got so many ounces of gold, and if I want to go buy a new car, it costs me X ounces of gold, and I just use my debit card. So that is possible. The problem is, the thing that it confronts is, think of central bankers as having a monopoly on central bank money, which they do. If you had a monopoly on anything and you had all the power, what's more powerful than printing money, right? If you control money, you control price levels, you control wealth, you control whether people have jobs or not, you control politics, you control pretty much everything if you control money. Right now that's in the hands of a bunch of PhDs from Harvard and Yale and MIT and Chicago and Stanford and Oxford and a few other schools around the world, but not many. It's a pretty short list of schools. I mean, actually, as an interesting exercise, go look at the resumes of the heads of the top 10 central banks in the world. Not hard to find. You can find that online. You'll find that they all went to like 3 or 4 schools, mostly MIT. So it's a club. They're in control. Why would they give up that control? Why? Who voluntarily gives up power? So you're going to the idea of saying, okay, now we're going to price things in gold by weight. That's the universal benchmark. That's the universal numeraire. We can use 21st century digital technology to hold our accounts. There's some gold somewhere behind the system, maybe in a vault or something, but my share of it is represented by gold units in my account, and that's how I pay for things. That's a feasible system, but you're never going to get buy-in from any central bank in the world. When you own gold, you're fighting every central bank in the world. So what is it that could cause the system to move in that direction? 2 things, a political earthquake, and maybe we're seeing one right now with the rise of Bernie Sanders, the rise of Donald Trump, the Brexit vote in the UK, backed by some flamboyant and charismatic politicians like Nigel Farage and Boris Johnson. Maybe we're seeing something like that. So let's kind of watch that space. But the other thing, I think the more likely path would be collapse, that there's a panic, bigger, much worse than 2008, massive destruction of wealth, a completely dysfunctional system, an emergency response, borderline neo-fascism, money riots, state power designed to suppress the money riots. And in that world, maybe when the leaders of the international monetary system realize that they've completely lost credibility, they're pushed into something that restores confidence, and that could very well be gold.
Very good. I'm glad that you mentioned the part about digital money, because we've actually had a lot of questions coming in regarding some form of digital currency backed by gold, and I think you're answering the previous question also handled some of those as well. So moving on, the next one is about the Fed and potential rate hikes for June. We've got a number of different questions coming in about that. One in particular, is there any reason, with the exception of a purely political move, to support Clinton for a rate hike in June? Most reliable sources point to a failed recovery. That's coming from Jim L.
I don't think the Fed is unaware of politics, but if you want to help Hillary Clinton, you would not hike rates in June. And that is what I expect. I know there was a lot of buzz today because the minutes of the April meeting were released, the April FOMC meeting, and those minutes included comments by some of the regional reserve bank presidents to the effect that if data were stronger and growth were higher and inflation were a little higher, the Fed should raise rates in June, and we saw an immediate reaction. Gold went down a little bit. Stocks went down a little bit. I don't get too exercised one way or the other about developments like that. I certainly pay attention to them. I mean, I'm not saying ignore it. I do look at it, and I'm enough of a geek. I read those minutes, and I read the speeches, and a lot else beside. But I don't think that you necessarily should react day to day. The Fed doesn't. The Fed actually, we talked about this conference in Switzerland where Claudio Barrio gave the speech about the anchor. Bill Dudley gave a speech the same day, and he made some comments. Sorry, he did give a speech then, but I was referring to an interview he gave to the New York Times. Sorry, but have a look at the interview in the New York Times, easy to find. And he said he was talking about the difference between a meeting with a press conference and a meeting without a press conference, and whether the non-press conference meetings were live in terms of raising rates and changing policy, et cetera. And he was trying to make the point that they were, that markets should not completely discount the possibility that they could raise rates at a meeting where there was no press conference. But in the same breath, he said, on the other hand, what difference does a month make? So he was being completely relaxed about, if you're going to do something, if you did it in June, July, or September, does it really matter? And he said, no, not that much. It matters in the aggregate, but one meeting versus another doesn't matter that much. So you had all this talk, and there were a couple data points recently that look a little hotter. Atlanta GDP Fed now, the GDP Now tracker is showing some strength. One of the inflation readings was a little bit hotter. You're going to have to see more than that to get the Fed to move. But just kind of going to the political aspect of the question, About a month ago, the president summoned Janet Yellen to the White House, and I use the word summoned by design. It's not unusual for a Fed chairman and a president to chat. I mean, they'll have breakfast or lunch periodically. Alan Greenspan and George W. Bush used to meet, once or twice a month for breakfast. So the fact that they talk is not unusual. What is unusual is that this was very short notice, very public. They invited in the press. They had Vice President Biden in the room, and a lot of people said, well, gee, what did they talk about? I got a lot of calls from the press. What did they talk about? I said, it doesn't matter what they talked about. It was all in the body language. It was the sight of the president sitting next to Janet Yellen in the Oval Office saying, in effect, the body language said, don't you dare raise interest rates. Because they did raise interest rates in December. That was the famous liftoff. And what happened? The U.S. stock market almost collapsed. It fell over 11% in 5 weeks from January 1st to February 11th. That was a meltdown. That scared them to death. So that's why they backed off all the rate hike, the four hikes per year, every other meeting, all that stuff that they laid out in December was completely blown up by the end of February, but they put the final nails in the coffin with Janet Yellen's speech before the New York Economic Club on March 29th, 2016. So that completely went by the boards. But the reason was that the U.S. economy was fundamentally weak. Raising rates would be enough to tip it into a recession. That could destroy the Democrats' chances of winning the White House because, generally speaking, and it doesn't matter which party's in and which party's out, if you have a recession in an election year, the out party wins. Simple as that. So with the Democrats being the in party and the Republicans being the out party, you have a recession in 2016. That's really going to help the Republicans and give Donald Trump a significant boost on the way to the White House. So the last thing the White House wants is for the Fed to raise rates. So that's what that was about. That was just a little bit of an intimidation, body language kind of exercise. So I think the hurdle is quite high for a rate hike this year. By the way, last December, I was one of the ones I made the mistake of believing the Fed. I actually believe what the Fed said, and I was expecting a rate hike in June, but it was very clear to me by February that was not happening. And now I don't see enough signs the other way to suggest that they will raise rates in June. So I'm still expecting no rate hike in June. I mean, you have to see some off-the-wall or off-the-charts data between now and then. It's possible, but I think it's very unlikely. And then forget September. Oh, by the way, sorry, one more reason they won't raise in June. The meeting is 6 days before the Brexit vote. The market, this is the referendum in the UK to leave the European Union. Of course, all the elites are lined up on the side of staying, kind of everyday people, and some politicians, Boris Johnson, Nigel Farage, two I mentioned, but a lot of others, including some former ministers in the UK, former cabinet ministers, are in favor of leaving the EU. The polls right now are very close. I don't know which way it's going to go, but I do know it's extremely close. I think we're sadly maybe one terrorist attack away from a leave vote. It wouldn't take much in a 50-50 contest, which is where it is right now. It wouldn't take much to tip that into leaving. The markets have not priced that in. The markets expect on balance that they'll stay. If you leave, what does that mean? I think if the UK leaves the EU, you'll see Scotland leave the UK. Scotland at that point will need some kind of money. They'll probably join the euro. The euro could actually get stronger. The UK has a conditional one-step removed call option on the ECB or the Eurozone's goal, which is 10,000 tons of gold. The UK could join the euro, and once you're in the euro, you in theory share in that 10,000 ton gold reserve. But if you leave the EU, then you have no chance. You give up your option to join the euro. You're on your own. The UK doesn't have that much gold, so they'd be completely cut off. City bankers would move to, there's already a bidding contest. Dublin and Monaco and Paris and Frankfurt are all getting their real estate agents ginned up and getting ready to move all these bankers to some other financial capital. Maybe it goes to Glasgow or Edinburgh in Scotland. We'll have to see. But the point being, that's an earthquake the market hasn't priced, and we don't know how it's going to come out. So do you really think the Fed's going to raise interest rates, which is a mini shock, 6 days ahead of what could be a mega shock that the markets haven't priced? Now you're back to the January scenario, or worse yet, you're back to the August 2015 scenario when China did that Pearl Harbor with that shock overnight 3% devaluation of the Chinese yuan. I asked investors, where were you on August 31st? Maybe you were taking your kids back to school or on a nice vacation, but you probably thought you were, if you weren't at the Grand Canyon, you probably thought you were staring into the Grand Canyon as far as the stock market is concerned, because U.S. stocks were crashing at the end of August. But that was all because of that Chinese devaluation. So that's how fragile the global economy is. You can't throw too many shocks at it without the whole thing breaking down, and they know that. So because they've had it twice, once in last August I just referred to, and again in January. So they don't want to do that again, and I can't rule it out completely, but I give it a very, very low probability. And also the politics come in. Janet Yellen is a Democrat, a liberal Democrat. That's not casting aspersions, it's just a fact. And, she wouldn't mind probably being reappointed by a Democratic president. And what President Obama was saying to her was, well, you need to do your part here for the party and not raise rates. So, and then I don't expect to raise it in September, because now you're talking literally 5 weeks or 6 weeks before the election. So it would be way too close, and the Fed's in the political crosshairs to begin with. They don't certainly want any political trouble. What if they cut rates, for example, and then the Republican somehow wins? They'll probably go burn down the Fed. So they might not raise rates at all until December at the earliest. I don't read too much into those minutes that came out today.
Okay, very good. Now, we still have a number of very good questions in the queue, and we've got a limited amount of time left, so we're going to try and get through some of these quickly if we can. Briefly, before we go to the next question, we've had some people asking about if people will be able to access these webinars after the fact, and the answer is yes. We record these and we will post them at physicalgoldfund.com/podcasts. We will send out a notification to everybody who's here on the webinar. We will let you know when that's available. And in addition to that, it's also available on iTunes. So the next question is kind of taking the other side of the analysis, Jim, to gold. This is coming from Peter W. from Germany. And he's asking, can you outline the most likely scenario in which the gold price would go down substantially in most currencies, and what probability would you assign to such a scenario?
Well, the likely scenario is obviously a deflationary scenario, but when you talk about going down, you have to distinguish between nominal dollar prices and real dollar prices. So let's just say that gold went, right now it's about $12.70 an ounce as of this afternoon. It fluctuates daily, obviously. Let's say that gold went down to $800 an ounce. So that would be a 30% decline from where we are today. A little bit more. That'd be like a 35% or slightly higher decline from where we are today, which would be a major drawdown. Well, what does that mean? The point is, nothing happens in isolation. If the nominal price of gold were to go from, say, $12.70 to $800, that means the price of everything else is going down more. That's a hyper-deflationary scenario. And, I once said to somebody, to one of my clients, I might like $500 gold better than $5,000 gold. That sort of puzzles people, but I say, look, the world of $500 gold is the world of 500 on the S&P and 2,000 on the Dow, and a complete destruction of financial wealth and 10% unemployment and a collapse of the economy worse than 2008. In other words, gold doesn't just go to $800 or $600 on its own. It goes there because you're in a hyper-deflationary, depressionary, panicked environment. In that world, I might want my gold even more than I do today. And so I think investors, it's a little simplistic to talk about the dollar price going up or the dollar price going down. First of all, I don't even think of it that way. I think of the dollar price of gold as just a cross rate. It's like, you can say the euro is worth $1.09, or there's 105 yen to the dollar, whatever it is. Those are all cross exchange rates. Well, I just think of the dollar price of gold as another cross rate between two kinds of money, dollars and gold. And when someone says gold went up or down, I think, well, no, the dollar went up or down. A higher dollar price for gold means the dollar is going down, and a lower dollar price for gold means the dollar is going up. In other words, the value of the dollar is going up, which is the definition of deflation. You get more stuff for your dollar. Well, in a hyper-deflationary world, there's probably so much disruption and so much wealth has been wiped out, you might want your gold even more. So first of all, distinguish between nominal and real. That's important. Understand that nothing happens in isolation. See, gold is not a stock. it's money. So yeah, an individual stock can go down. You can have a situation where the stock market's going up and an individual stock is going down because it's, Lending Club or Tesla or something happened to that company. Stocks are idiosyncratic, but gold isn't. Gold's a form of money. And if one form of money is going down relative to another form of money, then that's just a form of deflation. So understand that nothing happens in isolation. Distinguish between nominal and real. Don't get too euphoric if gold goes up a lot because it means that your dollar is worthless. And don't get too depressed if gold goes down a lot because that means that everything else is probably going down too. And this is a debate. You hear this from, and these are not, I think of the right word, but, you hear from people like Harry Dent and Michael Armstrong. They're out there with their blogs and their speeches and their newsletters talking about $800 gold. And I completely disagree, by the way. But if it were to happen, there would be so many other bad things happening at the same time that you'd be glad you had the gold.
Okay, very good. And then one last question here is that this is coming from Anthony K. And his question is, now that China has acquired some 2,000 tons of gold, are they now on par with the United States?
Well, it's a great question. Officially, China is approaching 2,000 tons of gold. I don't know whether the latest monthly update came out today or recently. It's possible that they hit that level. The last time I looked, it was around 1,800 tons. But, that's close enough for government work, as they say. But they're certainly closing in on 2,000 tons officially. But that's a lie. They have a lot more gold, and you can demonstrate why they have a lot more gold. I talk about this in my book, The New Case for Gold, also in The Death of Money. They have because those gold figures come from the central bank, but they have another sovereign wealth fund called the State Administration on Foreign Exchange, SAFE, S-A-F-E, and that's where they keep most of the gold. So what they do is they acquire the gold through SAFE, and then they don't reveal it, and then periodically they move the gold over from SAFE to the People's Bank of China. So it's just like taking gold out of one pocket and sticking it in the other pocket, and then the People's Bank of China publishes the new number, and everybody says, "Oh, China got some more gold." Well, no, they didn't. They had the gold all along. They were just keeping it in a place you couldn't see, and chose for their own reasons, really political and market manipulation reasons, to be transparent about how much more gold they added to the People's Bank of China. So that said, the Chinese actual number is closer to 4,000 tons. No one has the exact number because we have to use estimates from various sources, but they're probably around 4,000 tons, perhaps a little bit more. In terms of closing in on the United States, there are two ways to think about that. One is absolute tonnage, and if that's your measure, they're only halfway there. The United States has about 8,000 tons. My estimate is that China has about 4,000 tons. So they have about half the amount of gold that the United States has. But the other way to think about it, and I think this is useful, is a gold to GDP ratio. So take your gold at the market, divide it by your GDP, and the reason for that is if GDP is the size of your economy and gold is real money, which I think it is, then you're asking yourself, well, how much gold do we have to back up the economy? How much gold do we have to support a certain quantity of goods and services, a certain quantity of output? What's the real money supply relative to the size of the economy? By that measure, China has caught up with the United States. They have about half as much gold as we do, but their economy is about half the size. So on a gold to GDP ratio, those numbers are around 2%. They fluctuate, by the way, because economies grow and the amount of gold changes, at least in the case of China. So the numbers bounce around a little bit, but they've caught up to the U.S. At about 2% of GDP. But remember, the Chinese economy is growing a lot faster than the U.S. economy, so it's a moving target. So even if you caught up, you have to keep buying, because if you stand still, you're going to fall behind because your economy is growing faster, which means you have to buy more and more gold just to maintain the ratio. And certainly if you want to catch up in tonnage, get to 8,000 tons, which they probably do because they expect their economy will overtake the U.S. in the not-too-distant future, then you've got to keep going. They've got to buy another 4,000 tons, maybe more. And this is part of this scarcity dynamic we talked about earlier, which is there's only so much total mining output in the world, total mining, all the mines put together, about 2,000 tons a year, give or take. Well, with the Chinese out to buy, 2,000 tons a year, and that's 100% of the mining output in the world. Well, there are a lot of other buyers out there, not to mention jewelry and Indian brides and wedding rings and and watches and a lot of other things. So I think that tightness will continue. But the short answer is China has caught up in gold to GDP. They have not caught up in absolute tons, but for them it's a moving target because their economy is growing faster, so they have to keep buying.
Okay, very good. And from your experience and our experience in talking to and having conversations with the refineries over in Switzerland, we already know the huge amounts of gold that have been going over to China in recent years. And a yes or no answer, do you think the pace at which they've been buying is going to keep up?
Yes.
Okay, very good. All right, Jim, thanks so much for your time. We always appreciate it. Thank you, everyone who's participated in the webinar. We thank you for your questions. Apologize we couldn't get to the rest of them. There's still a whole bunch of really good ones. We encourage you to send questions in to info@physicalgoldfund.com. We'll put them in the queue, and hopefully maybe we can get them answered in the next webinar that we do. And with that, I will turn it back over to John.
Oh, thank you, Alex, and thanks to you, Jim Rickards. Have to acknowledge the shortest ever Jim Rickards answer there, but we love your long answers. Always a pleasure and an education having you with us. Most of all, thank you to our listeners for spending time with us today. Let me encourage you to follow Jim on Twitter. His handle is @JamesG.Rickards. So goodbye for now, and we look forward to joining you again soon.
You've been listening to part 2 of the latest podcasts from the Gold Chronicles with Jim Rickards, presented by Physical Gold Fund.